Hello, I'm Patrick Manzi, Chief Economist with the National Automobile Dealers Association, here to give you a third quarter of 2021 economic outlook. Let's start with a recap of recent auto sales. Through the first half of the year, new franchise light vehicle dealers sold 8.3 million new cars and light trucks across the country. In June, the SAAR came in at a 15.4 million unit seasonally adjusted annual rate, and this was down from May and April. Although May and April were very solid months, in June, new light vehicle sales were more supply constrained than demand constrained. April's SAAR of 18.8 million units was actually the fourth highest on record since the year 2000 for new light vehicle sales, and we believe that new light vehicle sales could have been even higher had there been enough inventory to meet the fleet demand out there. Continuing trends that we've seen throughout the past several years, new light trucks represented more than 3 out of every 4 new vehicles sold, but constrained inventory in those segments actually led some consumers to switch and purchase cars. Some car segments actually posted their first year-over-year market share gains that we've seen for several years. We don't expect that these supply issues are going to be resolved anytime soon, despite manufacturers doing their best to produce as many vehicles as possible. According to Ward's Intelligence, production in the third quarter of 2021 is expected to post a 5-year high at around 4.4 million vehicles produced in North America. But regardless, even if manufacturers were able to produce at full capacity for the next several months, we would still be a long way off from restocking dealer lots to pre-COVID levels. Even if the strong retail demand were to die off or be met by the production of these new vehicles, there are still a lot of fleet customers out there who in many cases placed orders for model year 21 vehicles, and now those vehicles are being pushed to 2022 model years. So we expect that these supply issues are going to be limiting the number of vehicles that dealers can receive from manufacturers for at least the rest of the year, and likely this is going to continue well into 2022 before we can see inventory levels normalized. Now, with the constraints on the new vehicle side, many consumers have had to turn to the used market. They are also now competing with dealers and large fleet buyers who also have a need for inventory. Now, as a result, the Manheim Used Vehicle Value Index was up by 36% in mid-June. And we do expect that these wholesale prices have likely reached their peak and will fall slightly and plateau throughout the rest of the summer. Demand for new vehicles is so high that according to J.D. Power, in mid-June, 75% of new vehicles sold were sold at MSRP or above. And this is up from 67% in May 2021 and well above the pre-COVID average of around 36%. As a result of all of this demand, manufacturers have significantly reduced their incentive spending. In June, average incentive spending per unit is expected to total just shy of $2,500. This is down over $1,800 compared to June of 2020 and nearly $1,500 compared to June of 2019. And in fact, this incentive spend per unit is the second lowest on record for the month of June. So for the rest of the year, if production surprises to the upside, a year of sales closer to 17 million units is not out of the question. However, we don't view that as terribly likely, and thus our forecast for the rest of the year is for new light vehicle sales to fall somewhere between 16.3 and 16.5 million units for the whole year. Of that total, we expect that fleet sales will account for about 2.5 million units, and this is up from 2020's fleet sales of 2.1 million units, but down slightly from 2019 sales of 3.3 million fleet units. So now let's discuss a little bit of what's going on in the broader economy. According to the Federal Reserve Bank of Atlanta's GDP Now database, second quarter 2021 real GDP is expected to increase by 8.6%. We do believe there is a chance that this number could surprise to the upside, potentially around 10% real GDP growth on an annualized basis. Now, for the year as a whole, we're expecting real GDP growth of around 7% and real GDP growth in 2022 of around 6%. Both of these would be very stellar years coming off of the tumultuous year we saw with COVID-19. According to the Consumer Price Index put out by the Bureau of Labor Statistics, prices in May jumped by more than 5% on a year-over-year basis. However, we need to consider the base effects, and by that I mean last year prices actually fell around the month of May, and so any change in prices needs to adjust for that because typically prices just go up. So once we adjust for base effects, the Consumer Price Index increased by a much more palatable 3% year over year. And of those price increases, we believe that many of them will be transient and only temporary, and they won't stick around for a long period of time. In fact, just price increases among used vehicles accounted for more than a third of those price increases in the Consumer Price Index. Now, the Federal Reserve has said that they're willing to tolerate some of these higher price increases for a limited time before they would move to raise the federal funds rate and increase interest rates across the economy. So for the year as a whole, we do expect that prices will increase by around 3% for 2021, and then in 2022, probably we will see price increases of around 2.5%. Both of those would be in the range that we believe the Fed would not raise interest rates in response to. And as a matter of fact, we don't expect any moves on the federal funds rate in 2021 or 2022. So that means at least 18 to 24 months of low interest rates, which should be a nice tailwind for new and used vehicle demand. So now let's turn to the labor market. In June, the U.S. labor market added 850,000 jobs, surpassing many analyst expectations. It was a really good month in June. At this point, we have recovered roughly 70% of the jobs that we lost during COVID, but we still have about 6.8 million more jobs to go. There are currently 9.3 million job openings as of the end of May, and this is a series record for that measure. Now, when you take a look at the average number of unemployed people per job opening, this gives us an idea of whether it's more of a worker's market or an employer's market. That measure has fallen to 1.1 unemployed persons per job opening at the end of May. So far, we've seen a lot of positive movements here with regard to people returning to work. We've also seen initial jobless claims fall significantly, but there is still room to go with getting more people back to work. And now let's also talk about consumer sentiment. Consumer sentiment has posted its second highest reading since COVID began. However, many respondents did note that high price gains had affected their outlook for the economy. Consumers have noticed the big price jumps due to demand for fuel and traveling as gasoline prices have gone up. They've also noticed the increases in prices for used and new vehicles and prices for homes. So all in, it seems that the American economy is really poised for a continued expansion. We expect to see a lot of steady growth. We expect to see continued steady jobs gains for the rest of the year. And we also expect that the new and used vehicle market are going to continue to be robust for the rest of the year. So looking ahead for the rest of the year, I see a lot of optimism out there with regard to the economy. I think it's going to be a great summer for dealers, and I wish you all a great summer in the rest of 2021.